Despite their low interest rates, many of us keep some money set aside in certificates of deposits, primarily because that money is safe and protected from any sort of market risk. That's because CDs are guaranteed by the FDIC, the Federal Deposit Insurance Corporation, which is underwritten or backed by the United States government. But there is another safe money guaranteed alternative to certificates of deposits. That also offers higher rates of interest for periods of 3 to 10 years. And this alternative is also insured, not by the FDIC, but by legal reserve insurance corporations that are required by state and federal regulations to maintain capital reserves equal to all of their contractual obligations, which protects the safety and liquidity of these contracts. Legal reserve contractor obligations are also backed by the state guaranteed funds for as much as $500,000 each, depending on your state of residence. So what are these safe money alternatives to bank CDs? They are known as multi-year guaranteed annuities. These are contracts between you and an insurance company for a specific compound rate of interest credited to your money over a specific number of years, usually 3 to 10 years, and their interest rates can be as much as double as what you might get on a 3-year CD. But unlike a CD, you do not pay tax on your interest earnings every year. You don't pay tax on your accumulated earnings until you or your heirs withdraw the money. When the contract expires at the end of the term, you can take all of your money and all your compound interest earnings in a single lump sum, or you can roll it over into another contract as you might with a certificate of deposit. If you decide to roll that money over into a new contract or keep it in the same account, you can continue the tax deferral. You also have the option to convert your savings into a regular automatic stream of fixed income payments for 10 to 20 years, or even guaranteed for as long as you live, and you would only be taxed on the interest portion of your payments, which can be an excellent way to supplement your Social Security income. If you need some or all of your money before the end of the contract, you can withdraw as much as you need or terminate the contract completely. If you need more than your interest earnings or more than 10% of your total account value, you will pay a penalty for early withdrawal just as you would with a bank CD. The penalty is only assessed on the amount you actually withdraw less the 10% allowance, and will vary depending on how many years are left on the contract. Most contracts allow you to withdraw all of your interest earnings, or up to 10% of your total contract value each year without any penalty. It is also important to know that if you terminate your contract or withdraw money before you reach the age of 60, the IRS will impose a 10% tax penalty on your interest earnings. So if you want an interest rate as much as double what you can get with a bank CD guaranteed and compounded for 3 to 10 years and don't want to pay tax on your earnings until you need the money, and you like having the option to convert your savings into regular income payments, all with the guarantee that your money will remain insured and protected, a multi-year guaranteed annuity might be for you. Interested? Then let's talk.